Understanding how professional traders operate starts with understanding how price is delivered. In the markets, price does not move randomly. It follows liquidity, reacts to structure, and delivers movement through a controlled process that most traders never learn to read. Welcome back to the ComLucro channel. In this video, we break down how the IPDA framework and the ICT Turtle Soup trading strategy work together to explain liquidity sweeps, false breakouts, and execution timing in Forex markets, including scalping scenarios. By the end of this video, you will see how liquidity, market structure, and execution connect into a single, repeatable trading framework. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Let us begin by laying the foundation. Before we explore the three main market analysis tools that every trader needs to master, we need to clarify what the market's underlying algorithm actually is. A specific algorithm shapes major market movements, and smart money, including market makers, banks, and large financial institutions, relies on it to guide price in their favor. This algorithm is known as the Interbank Price Delivery Algorithm, or IPDA. The Interbank Price Delivery Algorithm explains how smart money moves prices in a controlled and systematic way to seek liquidity, correct inefficiencies, and deliver price efficiently across the interbank environment. Knowing how this algorithm operates and how it behaves in real time gives you a clear advantage when anticipating future price movement. With that in mind, let us take a closer look at the Interbank Price Delivery Algorithm. IPDA delivers price efficiently to buyers and sellers in the marketplace, allowing price to move smoothly between buying and selling, while offering prices in both directions. This reflects a broader efficiency paradigm within the algorithm's logic, where the market constantly shifts between buy-side and sell-side to maintain balance. There are two primary ways IPDA achieves this: rebalancing inefficient price action and seeking liquidity. Now let us break down what each of these means in detail. The first way that IPDA operates is by rebalancing inefficient price action. In this example, we can see inefficient movement created by this large bearish candle. Because there were not enough buy orders in that specific area and at that moment, the price dropped with strong sell-side momentum and provided no buy-side delivery. This behavior is known as sell-side price displacement. To correct this, IPDA later provides buy-side delivery to fill and rebalance that sell-side inefficiency. The algorithm often produces inefficient movement and temporary disequilibrium in the market, where price travels in an imbalanced way. The market then works to resolve these inefficiencies by returning to those areas, filling the gaps, and restoring equilibrium. This ongoing cycle of imbalance and rebalancing is a core characteristic of price movement, creating opportunities for traders who recognize these inefficiencies and anticipate the rebalancing process. The second method is seeking liquidity, also known as the pairing of orders. Here we have an example to illustrate how the algorithm searches for liquidity in the market. As you can see, price has formed a range, and there is strong sell-side and buy-side liquidity, both below and above this structure, created by clusters of buy-stop and sell-stop orders. We can observe that price moved sideways inside the range, until the algorithm began manipulating the market by pushing price outside of it. This often occurs during a news event or during a session open. When buy stops are triggered, the market experiences a burst of buying interest, creating a bullish move. After activating those buy stops, the algorithm shifts direction, driving price downward and distributing that buy-side liquidity toward the sell stops positioned below the range. Once the price sweeps the sell-side liquidity, the sell stops below the range pair with buy orders, and price then pushes upward toward the buy stops above the latest swing high. Then, the buy stops above that high pair with sell orders and are distributed back down toward the sell stops. The algorithm repeats this cycle continuously, engineering and regenerating liquidity throughout the market. It does this to make manipulation easier, absorb more liquidity, and fulfill large institutional orders. Understanding how this algorithm works helps you protect your capital and avoid being on the wrong side of institutional moves. This is how traders apply IPDA in practice. They identify areas where institutions are likely to act, anticipate liquidity grabs around key levels such as support and resistance, recognize manipulation patterns, especially during session opens, and wait for inefficiencies to be filled as part of efficient price delivery. Once you understand that the algorithm constantly seeks liquidity and engineers stop runs, the next step becomes practical. How does this behavior actually appear on the chart? In a way traders can execute with structure and discipline. One of the clearest and most repeatable expressions of this logic is when price breaks an obvious level, triggers resting stops, and then quickly reverses. This behavior is known as a false breakout. That exact sequence is what the ICT Turtle Soup is designed to trade. Now let us continue and talk about liquidity sweeps, because this is the event that activates the Turtle Soup setup. Without a sweep, there is no trade. A liquidity sweep happens when large orders enter the market and intentionally trigger clusters of pending buy or sell orders. This creates fast and aggressive price movements that often catch traders off guard. These sweeps always occur at buy-side or sell-side liquidity levels. They are not random. They happen where stops are concentrated and where the market can access liquidity efficiently. A sell-side liquidity sweep occurs when price moves down into a sell-side liquidity level, trades below it, triggers stops from buyers, and then quickly reverses back upward. A buy-side liquidity sweep occurs when price moves up into a buy-side liquidity level, trades above it, triggers stops from sellers, and then quickly reverses back downward. This sharp rejection after the sweep is the first clue that the breakout was not real and that price may be preparing for a move in the opposite direction. Next, let us talk about market structure shift, because this is the confirmation step of the Turtle Soup strategy. The sweep shows intent, but structure tells you whether that intent is being accepted by price. A market structure shift helps identify a potential change in direction. It shows when the previous control in the market starts to weaken and a new short-term bias begins to form. In a bullish market structure shift, price first forms a low. Then it creates a lower high, followed by a lower low. The shift happens when price rallies and breaks above the previous lower high, forming a higher high. This tells you that bearish control has been disrupted. In a bearish market structure shift, price first forms a high. Then it creates a higher low, followed by a higher high. The shift happens when price drops and breaks below the previous higher low, forming a lower low. This signals that bullish control is starting to fail. After a liquidity sweep, the market structure shift is what separates patience from impulse. It confirms that the move after the sweep is not just a reaction, but the beginning of a new directional move. So let us put everything together and walk through how to identify the ICT Turtle Soup setup step by step, on a bullish scenario and within an internal range context, which I will explain in more detail later. First, start on a higher time frame, in this case, the 1 hour. In the bullish scenario, your focus is sell-side liquidity, because that is where long stops tend to rest, below clear lows. Mark the most obvious levels, such as recent swing lows, previous day low, or previous week low. Then, once those liquidity areas are marked, wait for price to sweep that sell-side liquidity and close back above the level, returning inside the range. In many cases, this will appear as a candle that trades below the low and then closes back within the range, signaling a failed breakdown. However, in fast market conditions, this return can happen quickly and without much consolidation. After that, move down to your lower time frame, in this case, the 5-minute. This is the time frame you will use for execution, not for prediction. Here, You wait for a bullish market structure shift or a bullish change of character, meaning price starts to break above a key lower time frame swing high after the sweep, showing that bearish control is weakening. Here at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame buy-side liquidity. The same logic applies to the bearish scenario, with everything inverted. In that case, you focus on buy-side liquidity, wait for a sweep above highs, look for a bearish market structure shift, and then execute using the same confirmation and retracement principles. This process keeps you aligned with context first, confirmation second, and execution last, instead of chasing price or guessing reversals. This brings us to the two main types of ICT Turtle Soup setups, because context matters just as much as the pattern itself. First, the external range Turtle Soup. This setup happens when price moves outside of a clearly defined market range. Price breaks above a high or below a low, sweeps liquidity, and then reverses back into the range, often moving toward the opposite side. This type is commonly seen near range extremes and major highs or lows. This is the type of example we will demonstrate next on the chart. On a bullish external range Turtle Soup scenario, the context is defined by a trending market that temporarily fails at the range extreme. First, start on a higher time frame, in this case the 1 hour, and identify a clear bullish structure with higher highs and higher lows. In this scenario, your focus is buy-side liquidity resting above the recent highs, where short stops and breakout entries tend to accumulate. Price often makes a shallow pullback, sometimes not even forming a clear higher low, and then pushes above the previous high. This move sweeps buy-side liquidity above the high, triggering stops and attracting late breakout buyers. Then, instead of continuing higher, price fails to hold above the high and starts to reverse, signaling that the breakout was false and that liquidity has been taken. After that, move down to your lower time frame, in this case the 5-minute. This is the time frame you will use for execution, not for prediction. Here, you wait for a bearish market structure shift or a bearish change of character on the lower time frame. This occurs when price breaks below a key internal swing low after the sweep, showing that bullish control is weakening and that price is no longer accepting higher levels. Here, at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame sell-side liquidity. The same external range logic applies in a bearish market as well, with everything inverted. In that case, price sweeps sell-side liquidity below lows in a bearish trend, fails to continue lower, forms a bullish market structure shift, and execution follows the same confirmation and retracement principles. This process keeps you aligned with context first, confirmation second, and execution last. At this point, the execution framework is complete. You have seen how IPDA logic, liquidity sweeps, and market structure connect into a practical decision-making process. To bring everything together and help you apply this with more precision, we are now going to play a short clip from another video linked in the card. In that video, we break down 10 clear and practical rules to identify institutional supply and demand zones with confidence. Have you ever wondered how institutional traders consistently identify high-probability supply and demand zones before the market makes its move? Welcome back to the ComLucro channel. In this video, we are going to break down that exact process using smart money concepts, so you can understand why price reacts where it does, not just where it appears attractive on the chart. You will learn 10 clear and practical rules to identify institutional supply and demand zones with precision. Follow the framework step by step, wait for confirmation, and you will start seeing the market through a true institutional lens. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.